All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. And oh, by the way, I do have an ebook that costs 25 bucks that goes more in depth with respect to the free ebook, and it actually has links to videos that are up in the cloud that you can access that actually show you or demonstrate the various strategies that we use or that we teach here at Cubicle Investing to trade options. And so it also talks about some of the things that we look for, some of the criteria that we look for in order to identify whether or not a underlying is a good candidate for a vertical credit spread, which is what we primarily trade here is vertical credit spread. So there's a free ebook. And there's also an ebook that costs 25 bucks. So again, going to the website cubicleinvesting.com, you will have access to either one of those products if you are interested. And to be honest, you should be. And also we do have a weekly newsletter. So if you download the free ebook, you will start to receive our weekly newsletter called the Cubicle Weekly Reader, where we talk about, stock investing, crypto investing, and just the world and finance in general. So, and that comes out every Monday at 10 a.m. Eastern Standard Time. All right, so today is Saturday, January the 21st. Obviously, the market is closed. It's approximately 11:21 a.m. Eastern Standard Time. So for you guys who trade the SPX 0 DTE, I think you will agree with this statement that it's been pretty challenging to trade the SPX 0 DTE in this particular environment. And the reason being, at least from my perspective, is that the VIX has been on a decline. And so the VIX, the VIX, let's just take a look at it right quick. All right, so the VIX is basically the fear gauge, the so-called fear gauge of the market. So the higher the VIX, the more fear supposedly that's in the market. And so the higher the premiums, or the more inflated the premiums will be for selling vertical spreads on the SPX. So having said that, because the VIX has been on a decline, and particularly it's been below 25 really year to date, the premiums have not been very inflated, and also the IV rank on the SPX has been well below 25 and also 30. Has been well below 25. And we saw the IV rank above 25 kind of consistently last year. So it was particularly near the end of 2022, the IV rank was pretty high. And so the higher the IV rank, again, the higher the premiums are for selling these vertical credit spreads. So I've been doing, so as a result of the VIX being low, the premiums being rather deflated and not inflated. And again, you have to put on, if you want to get a higher credit, you got to get closer to the price of the underlying. Thus, you got to take more risk. All right, so what I've been doing is I've actually been doing one DTE SPX trade. So basically, getting in the trade within the last 45 minutes of a trading session for the expiration date that expires the next day. So hence one DTE. And so I did that on this past week. Let's see here. So I did that this past week, and I've been doing that, like I said, pretty much year to date. Doing these one DTE trades on SPX. And so I got into a trade on Thursday. So this candlestick represents Thursday's price action. All right, so Thursday was January the 19th. And so, considering that we had a significant pullback on Wednesday, right? And then on Thursday, we also had a pullback. I was pretty confident that on Friday, we would have an oversold bounce, right? So I got on the put side. I got in at 38.95. That was my short strike. And my long strike was 38.90. So I sold at 38.95. I bought the 38.90. Now, as you can see here, so I got in the morning. And what am I doing here? So as you can see here, the price actually, if we look up here, I'm hovering over this candlestick, the price actually got below. So it got as low as 38.85 and some change. So the price of my short strikes, both of my short strikes were in the money. They were both in the money, right? But I was pretty confident that come Friday, which was the expiration date for that particular vertical put credit spread, come Friday that we would have an oversold bounce and that the market would actually go back up. And it did exactly that. So I was able to close this trade out, this one DTE trade out on SPX for a full profit. I think I sold four contracts. However, I broke my rule in that I turned this position that I had on, that I put on Thursday, on Friday, I turned it into an iron condor. So I went on the call side and I sold a vertical call credit spread. I sold at 39.30 and at 39.35, thinking that the price of the underlying would pretty much trade sideways the entire Friday's entire session. And obviously it did not, because you can see here the price ended up breaching my vertical. I'm sorry, I don't think I was at I was at 30. I'm sorry, I was at 39. I was at 39.50 and 39.55. I apologize. Yeah, so but nevertheless, the price of the underlying still broke through. But here's the thing, because the price of SPX, it moves rather slowly. I actually had time to close out the trade before I realized a complete loss. So in other words, I had 4 contracts here as well. So we know that, there's a $5 difference between the spread here. So every option contract controls 100 shares. So 5 times 100 is 500. 500 times 4 option contracts is 2,000. So before I experienced a complete loss of $2,000 on this trade, I was able to close out the trade, the vertical call credit spread, when the price of the underlying was in between 39.40 and 39.35. So I actually had somebody submit a comment to my YouTube channel saying, "Hey man, you're actually risking a lot of capital just to pick up maybe 10 or 12% of what you're risking." And I said, well, it depends on how you look at it, because considering that the SPX actually gives you time to consider whether or not you want to close out your trade or keep it on, because it moves slowly, you can still close it out and experience a small loss, right? So it's very rare that you will experience a complete loss, unless you're willing to stay in the position and you think for some reason, you're thinking and you're not actually observing or processing what you are seeing. So I was processing what I was seeing and not thinking that the underlying would actually pull back. So based upon what the advancing declining indicator was showing me was that, hey, this thing is continuously pumping. And also the 11 sectors that make up the S&P 500, they were all turning green. Specifically, the XLK was over 2%. So I said, hey, this thing is going to continue to run up. So let me just go ahead and just close out my vertical call credit spread, which I should not have put on anyway, because I normally don't turn a put spread into an iron condor. But But I say, hey, let me just close this out now and take the small loss because it looks like that, you know, if I stay in it, my position's going to get run over. And that's exactly what would have happened had I stayed in the position. So, you know, I experienced a small loss of $150, but nevertheless, as you can see here, just on the few SPX trades I have done this year thus far, I'm up, you know, I'm up $2,000. So, but that's not the only underlying we trade. So we have been trading the Goldman Sachs GS, which experienced a major pullback because of bad earnings report news. Bad news during the earnings report. So we like to get in on the put side when a pretty well-capitalized underlying has a major pullback. So I had a major pullback as a result of the earnings report. So we are on the put side on Goldman Sachs, and it's doing quite well. And we also have been trading Tesla. Tesla has been very volatile. Tesla's a very volatile stock that we like to trade. So we've been trading, and again, we primarily trade, you know, vertical put spreads because the market has an upward bias, and so we like to be on the put side versus the call side. And also we've been trading Oxy, OXY, you know, so, and we've been trading naked options on Oxy, you know, so this year has been good thus far, but specifically for the SPX 0 DTE, it's been rather challenging. So for you guys who trade the SPX 0 DTE, in the comments, let me know how you have altered your strategy, if you have at all, or how you are dealing with this current environment with trading the 0 DTE on SPX.